44%. I want you to just sit with that number for a moment. 44%. That isn't a correction. That is not a bad quarter. That is a life-altering wealth destruction event.
It is.
And historically, that is the average crash, not a dip, a crash that hits the stock market when a very specific, almost ghostly signal appears in the bond market.
And it's a signal that has, well, perfect track record. It doesn't miss.
It happened right before the dot-com bubble burst. You remember, in the early 2000s? It happened before the 2008 financial crisis tore the entire global banking system apart. It even happened right before the world shut down for COVID.
Yeah.
And the reason we're doing this deep dive today, the reason we dug through all the latest financial reports and market analysis, is that the signal is back. It started blinking red in June of 2024, and as we sit here in early 2026, it is screaming.
It is screaming, and what is frankly terrifying about this specific moment is the silence surrounding it. You look at the retail investor, you look at the headlines, and the mood is still, euphoric.
Oh, absolutely. It's still by the dip.
It's still by the dip.
Yeah.
Everyone thinks the party's going to go on forever. There is this massive, dangerous disconnect between the cold, hard math of the bond market and, I guess, the psychology of the stock market.
That's our mission today. We're not here to fearmonger just for the sake of it. We're here to look at the big picture of the U.S. economy. We're going to take this bond market signal, which sounds complicated, but we will break it down and connect it to the, rotting foundations in the labor market and the manufacturing sector.
Right.
We need to explain why a crash isn't just a possibility, but it's becoming mathematically probable.
Exactly. Because the bond market is just math, and math doesn't lie. And when you layer that math over what's actually happening on factory floors and in HR departments across the United States, the picture becomes very clear. This isn't some technical glitch.
No.
It's a warning siren.
So let's get into the mechanics. The reports, all the latest news, they keep referencing this technical term, the bear steepener. Now, to the average person, that sounds like a bad day at the zoo. But in finance, it's arguably worse. Break this down. What exactly is a bear steepener?
It sounds complex, but the concept is actually quite intuitive. You have short-term interest rates and you have long-term interest rates.
Okay.
In a healthy economy, long-term rates are slightly higher, right? Because you're locking your money away for longer, so you get paid more.
Sure, for the risk.
For the risk. A bear steepener happens when long-term interest rates, and we're talking specifically the 10-year Treasury note shoot up much faster than short-term rates.
So, practically speaking, the cost of borrowing money for a long time for things like a 30-year mortgage or, a company building a massive factory is getting a lot more expensive very quickly.
Precisely. And we have to ask why that happens. It's usually a sign of mounting fiscal pressure. It's the market looking at the U.S. government and saying, we don't trust the long-term stability here. We think inflation is coming back, or we think the debt is unsustainable. So we demand a much higher return to lend you money for 10 years. It tightens financial conditions aggressively. It's like throwing sand in the gears of the entire economy.
But there's a nuance here in the sources that I think is critical. Everyone on cable news talks about the 2-year versus the 10-year spread. They watch that like a hawk.
They do.
And right now, that spread is near a 4-year high, around 69 basis points. But you're focusing on a different metric. The sources call it the profit of doom.
The 2 years important, sure, but the smart money. The institutional historians, they are looking at the spread between the 3-month Treasury bill and the 10-year Treasury note.
Why the 3-month bill? That seems incredibly short-term. I mean, it's basically cash. Why is that the superior indicator?
That's exactly why it matters. Think of the 3-month bills as the sensitive detection chips of the economy. They are the scouts. Because they're so short-term, they react instantly to immediate liquidity drying up. They feel the pain first. If the 10-year note is a giant oil tanker that takes miles to turn, the 3-month bill is the speedboat that spots the iceberg.
Okay, so the speedboat is spotting an iceberg. Walk us through the pattern. What does this signal actually look like on a chart right before things fall apart? Because we need to know what we're looking for.
The pattern is consistent, and it is eerie. It happens when the yield on that 3-month bill falls faster than the 10-year yield. Basically, the curve steepens after being inverted. When that specific dynamic happens, a recession has followed every single time in the last 25 years.
Every single time. There were no false positive, no almost moments.
Not in the major cycles we're looking at. Let's look at the evidence. Go back to October 2000, the dot-com bubble. Do you remember the vibe then?
I do. Everyone was a genius. If you had .com in your name, you were worth $1 billion. It felt like the rules of gravity just didn't apply.
Exactly. Euphoria. But this signal flashed. The 3-month yield dropped faster than the 10-year. The bond market sensed the liquidity drying up before the stock market did, and the result, the S&P 500 dropped 47%.
47%. That cuts a retirement portfolio in half. That ruins plans.
Almost half.
Right.
Then jump to January 2007. The housing market was unshakable. Housing prices only go up, right? That was the mantra.
Right.
The signal flashed again. What followed was the global financial crisis, and the S&P 500 dropped 56%.
Ouch. That wiped out a generation of wealth.
And then, most recently, May 2019, before anyone had even heard of COVID-19, this signal appeared. The market was already fragile, fundamentally. When the catalyst hit, the market dropped over 30%.
So this brings us to the present, or rather, looking back just a bit. This ghost signal, this exact pattern, it returned in June of 2024.
It did. And here is where it gets deceptive, and where investors get trapped. Since June 2024, the market's actually rallied for a while. There's often a lag. It's that Wile E. Coyote moment, where he runs off the cliff but hasn't looked down yet.
Right.
But if you look at the analysis from the last 2 to 3 months leading into where we are now in 2026, that momentum has completely died out.
Liquidity is drying up.
It's evaporating.
Yeah.
The mechanism is primed. The bond market is effectively screaming that the buy-the-dip mentality is about to lead investors right off that cliff.
Okay, I want to play devil's advocate here, because I can hear the listener saying, okay, that's just lines on a chart, that's technical mumbo-jumbo, I see help wanted signs everywhere.
Sure.
Maybe the bond market is wrong, maybe this time is different. We need to look at the real economy. Does the world outside of Wall Street match this terrifying math?
That is the critical question. If the real economy was booming, we could maybe ignore the bonds. But unfortunately, the answer is yes, they match. The bond market is reacting to rot in the real economy. And it starts with the labor market.
But wait, I see headlines all the time about unemployment numbers being low. The U.S. consumer is resilient, jobs are plentiful. Is that just propaganda? Or are we missing something?
It's a statistical mirage. You have to scratch the surface. The headline numbers, they look okay, but the underlying data is deteriorating fast.
Right.
First of all, we have to understand the replacement rate.
Okay.
To just keep up with population growth and people retiring, the U.S. economy needs to create about 100,000 jobs a month. That's the break-even point.
100,000. Got it. That's the baseline. And what are we actually doing based on the latest reports?
The recent ADP private payroll reports showed only 22,000 jobs added.
22,000? That's barely 20% of what we need just to stay flat.
Exactly. We are shrinking relative to the population. And to make it worse, the previous month's numbers were revised downward. So we thought we were doing okay, but we weren't. We are barely creating any jobs at all.
Wow.
But the most damning statistic, and this is the aha moment for me in these reports, is the quality of the jobs that do exist.
All right, this is the stat that really stuck out to me. Part-time for economic reasons. Explain what that means, because it sounds like jargon, but it impacts real families.
It is a technical term for a very human tragedy.
Okay.
These are people who want to work full-time. They need a full-time salary to pay their mortgage, buy groceries, keep the lights on.
Of course.
But they can't find full-time work, so they are forced to take part-time hours. They're technically employed, so the headline unemployment rate stays low, but they are earning half of what they need.
And what is that number sitting at right now?
It has hit 5.34 million people. That is the second highest level since 2021, and it is actually higher than the levels we saw during the 2001 recession.
Wow. So over 5 million people are essentially underemployed and likely burning through savings just to survive.
Exactly. And think about what that means from a corporate perspective. It's what we call quiet firing. Companies are hoarding workers because they're afraid to let them go entirely. Maybe they remember the labor shortages from a few years ago.
Right, they don't want to get caught flat-footed again.
But they are cutting their hours to the bone. They aren't offering stability. They are waiting.
Which means those households are under immense pressure. And the reports mention credit card delinquencies are rising, which makes perfect sense. If your hours get cut, you don't stop eating. You put groceries on the Visa.
Right. And eventually, the Visa maxes out. That is when the consumer breaks. And in an economy that is 70% consumer spending, when the consumer breaks, the whole thing comes down.
So the labor market is a hollow shell. Let's pivot to the other pillar of the economy, making things. The manufacturing sector. There's an analogy in the sources about a bakery that I thought really clarified the situation. Because manufacturing data can be, dry, but this made it click.
Yes, the bakery analogy perfectly illustrates the bullwhip effect we were seeing. Imagine a baker. He only has firm orders from customers for 10 loaves of bread.
Okay.
But he's anxious, or maybe he's just operating on old schedules from the boom time, so he keeps baking 100 loaves.
The shelves are going to get full very fast.
Exactly. The backlog is full. In economic terms, this is the gap between production and new orders. Right now, that gap is the widest it has been since early 2009, right in the depths of the great financial crisis.
So we're producing stuff that nobody has ordered. We're building inventory that nobody's buying.
Correct. And what happens when the baker realizes the shelves are full and the bread is going stale? He doesn't just slow down, he stops baking entirely.
And he fires the assistant baker.
Exactly.
Yeah.
The backlogs are currently clearing out. Companies are living off the work they had piled up. But once that backlog is gone, there is no work left. The prediction from the analysis is that mass layoffs are the next logical, inevitable step. We're already seeing middle managers being cut. That's usually the first wave. The broader workforce is next.
And the sources mention that while the services sector, restaurants, travel, tech support, seems okay right now, it usually lags behind manufacturing.
Manufacturing leads. Services follow. It's simple cause and effect. If the factory workers lose their jobs or get cut to part-time, they stop going to restaurants. They cancel the vacation. They downgrade their internet package. It's a domino effect.
So we have the bond market signal flashing red, we have a hollow labor market, and we have a manufacturing sector that is essentially running on fumes.
That's the picture.
And that brings us to the people who are supposedly driving the bus. The government, specifically the U.S. Treasury. Now, we have a Treasury Secretary, Scott Bessent, and this guy isn't a career politician, right? He's a market guy.
He is. Scott Bessent is a former hedge fund manager.
Yeah.
He speaks the language of the bond market fluently. He knows exactly what these charts mean. And because he knows, his recent actions are, well, they're revealing. They suggest panic.
He made a move recently regarding bond auctions. Break that down for us. What did he do, and why should the average person care about bond auctions?
He announced a freeze on increasing the auction size of long-term bonds.
Yeah.
We're talking notes and bonds for the next several quarters.
Okay, freeze on auction size. Translate that.
It's a supply and demand game. The government needs to borrow massive amounts of money to keep the lights on. Usually they issue a mix of short-term and long-term debt.
Right.
But Bessent sees that long-term rates are trying to skyrocket.
Right.
Remember the bear steepener we talked about? He wants to stop that. He knows if the 10-year rate goes to 5% or 6%, the economy collapses. So he is choosing to flood the market with short-term bills instead.
So he's keeping short-term rates high by dumping supply there, but trying to starve the long-term market to keep those rates down artificially.
Exactly. It's a desperate act of manipulation. It's effectively yield curve control, without officially calling it that.
The source described it as trying to put out a fire with one hand while pouring gas with the other.
That's a perfect description. By keeping short-term rates high, you're tightening the noose on immediate liquidity for businesses. But by trying to artificially suppress long-term rates, you're admitting you are terrified of what happens if they rise naturally. It confirms that the people at the very top,
The Treasury Secretary himself.
the Treasury Secretary himself, are worried about a crash. They see the same signal we do.
That is sobering. It's one thing when an analyst on TV says crash. It's another when the Treasury Secretary starts changing the plumbing of the financial system to try and prevent one.
It validates the thesis. The structural integrity is compromised.
Okay, so we've established the ghost signal is flashing red. We've established the labor market is cracking and manufacturing is overproducing, and the government is in panic mode. So let's get practical. The listener is looking at their 401k, their savings. What do? The sources had some very specific strategies.
They did. And obviously, we have to say this isn't personalized financial advice. Everyone's situation is different. But these are the strategies being discussed by the experts in the reports to survive a 44% drawdown.
Okay.
The first one is a classic defensive pivot, sector rotation.
Right, moving out of the things that need a booming economy.
Exactly. The analysis suggests moving out of banks, technology, and cyclical stocks. If the economy crashes, banks suffer from loan defaults. Remember those credit cards maxing out?
Right.
And tech stocks, which are often valued on future growth, they get crushed when liquidity dries up.
And where do you go instead? Where is the shelter?
You go to the things people can't live without: defensives, utilities, and healthcare. Even in a deep recession, People need electricity and they need medicine. These sectors tend to hold their value much better when the S&P 500 is taking a nosedive.
So you might not double your money, but you won't lose half of it.
That's the idea.
That makes sense. Shelter in place. But there is another point that was emphasized heavily, specifically quoting the bond king, Jeffrey Gundlach, and that is cash is king.
Yes. Gundlach is recommending a minimum of 20% of the portfolio in cash.
20%. Now, I know some people hate holding cash. They feel like inflation is eating it away. It feels like it's doing nothing.
But in this environment, it's not doing nothing. It's doing two things. First, it's safety. Cash doesn't drop 44% overnight. But secondly, and more importantly, it is ammunition.
Ammunition. Explain that mindset.
If the market drops 44%, like the history suggests it could, cash allows you to step in and buy high-quality assets at half price. You can't buy the dip if you're fully invested and your portfolio has just been cut in half.
You need dry powder.
You need dry powder. So cash isn't just about hiding. It's about preparing for the opportunity of a lifetime on the other side.
Exactly. Wealth is often transferred during these crises, not created. The people with cash are the ones who end up with the assets when the dust settles.
That's right.
Now, for the people with, as the report put it, strong stomachs, there was one more aggressive strategy mentioned for those who want to profit from the way down.
Yes, tactical shorting. The sources suggest that as the momentum fades, and remember, we've seen momentum die out over the last few months, there is an opportunity to short the major indices, specifically big tech.
Betting against the giants, that sounds dangerous.
It is risky. Timing is everything. But if the bear steepener plays out like it did in 2000 or 2008, the highest flyers fall the furthest. The companies with the highest valuations have the most air underneath them.
So, to recap the strategy, get defensive with utilities and healthcare. Raise cash to at least 20% so you have ammo. And if you're a pro, you look at shorting the tech-heavy indices.
That is the playbook the bond market is dictating.
This has been a heavy deep dive, but a necessary one. We started with that number 44%, and we've walked through why that number isn't just a scare tactic. It's a historical probability based on the signals blinking right now.
We have the ghost signal of the 3-month versus 10-year yield.
Right.
We have the hidden weakness of over 5 million people working part-time who want full-time jobs.
Right.
We have a manufacturing bakery overflowing with unwanted bread. And we have a Treasury secretary freezing auctions to try and hold it all together.
It really feels like we are standing at a precipice. You know, for the last decade, the rule has been simple. Stocks always go up. Buy the dip. Don't think, just buy.
That worked when money was free and liquidity was endless. But the regime has changed. The tide is going out.
And that leads me to my final thought for you listening right now. Everyone around you, your neighbors, the news anchors, maybe even your financial advisor, might be screaming, buy the dip because it's muscle memory, it's what worked yesterday. But if the bond market, the smart money, the people who actually fund the government, is terrified, why aren't you?
That is the question. Are we walking into a new era where the old rules are about to be broken by a 50% reality check?
Something to think about. Keep your eyes on the yield curve, not the headlines. Stay safe out there.
Thanks for listening to The Deep Dive. Take care.